All right, guys, so in this video, I'm going to be breaking down all of the exact financial metrics that you need to know about in commercial real estate and how commercial real estate deals are valued. Applies to every asset class. This is really just understanding the basic key metrics, like how does cap rates affect values, which it's honestly irrelevant, cash on cash returns, debt service coverage ratio, internal rate of return, what those actually mean. And I'm going to explain it in layman's terms so you guys could get a true understanding of it instead of like the uber technical examples that you see online and definitions online that really don't make any sense, and it's kind of hard to actually apply it to real life. So on my screen here is a really in-depth underwriting that I did on this is a 130 unit, $5 million property that I have under contract or going under contract in North Dakota. You'll see here we have like a whole 10-year internal rate of return model, the expenses, operations, things like that. To make this simple, here's the actual valuation page, and you'll see that this says from earlier, you'll see that there's like anticipated trading range. Just bear with me, guys. This isn't an actual evaluation I did for a client. This is after us evaluating numbers, but basically what we were doing here was we were modifying seller finance terms to cover the seller's down payment and seeing how we could, move the numbers to get a healthy internal rate of return for the seller or for the buyer, so we could, get them together and agree on terms. But the main metrics that we're looking at when we are looking at the value of a property is going to be one, cap rates, which is just, the NOI based off the purchase price. Two is like, does it cover debt service at the 1.25x threshold? I'll explain what that is. And then, basic stuff like cash on cash returns that you'll see here. And then like what this internal rate of return of 25% in year 7 actually means. Now, let's go to Excel. So when I'm looking here, let's talk about the very first thing, cap rates. So cap rates, completely irrelevant. They almost don't mean anything important. A cap rate is just a quick and easy way to say like what something's priced at. So to give you an example, if a business is making $100K in straight cash flow per year, and it was sold at a 10x multiplier. This is business terms, a 10 times multiplier on the EBITDA. EBITDA is the same as NOI, basically the net income of that business or property. Commercial real estate is just real estate, that's a business. Net income is 100K, so a 10 times multiplier is literally just going to be a 10 times this. Sorry guys, that thing popped up on my screen. That's $1 million. So this is actually the same as a 10% cap rate, because for your $1 million purchase price, the cash flow is 10% of that, 10% cap rate. So let's do a $10 million property. Make this simple. A 6% cap rate on a $10 million property is going to be $600K. All right. And now this is an inverse relationship, right? So the higher the cap rate, the lower the purchase price is in comparison to the NOI. So let's say, we're going to say cap rate. So let's say we know a property is making $600K, and here is the cap rate. We're going to put the number in here. We're going to do equals this divided by this. Okay. If something is making $600K and I want to price this at a 7 cap, we'll divide that. I'll put 0.7 here. So 7 cap is now, okay, sorry guys, I made that a 0.7 cap. 7% cap rate is $8,571,000. If I wanted to make this a 6 cap, divided by 0.06, you'll see it's exactly that 10 million, 6% return on that. And this is assuming you're buying it in cash. And no one buys properties in cash, which is why cap rates are irrelevant. Cap rate's just a quick way to say, what is this priced at? So the lower the cap rate, the higher the purchase price goes. So if I put this at a 4 cap, that purchase price gets higher. And then the higher the cap rate, it's a lower purchase price, and like it's a higher return based on that purchase price. So if I go to 10, for example, like a 10x multiplier, you will see That 600,000, 10 times multiplier, 6 million. So that's the difference between business valuations and cap rates. Trying to make this really simple for you guys to understand. Let's talk about debt service coverage now. So let's say we kept this cap rate at a 0.06. All right, we're at 10 million. Let's say to buy this property, you put a down payment of 300,000 with the bank. Okay. So I go to the bank, I'm like, hey, what terms can you lend us to me? They'll come up whatever interest rate, whatever amortization, whatever term schedule. This isn't about financing right now. I'm just giving you the macro terms. $300,000 down to buy this property, and now the debt payment on that is going to be $500K. Debt costs is going to be $500K. Your cash on cash returns now, well, let's stick with debt service coverage. So the cost to service that debt is $500,000 a year. So your debt service coverage ratio, DSCR, is going to be the ratio that this covers that debt. So basically that is, in this case, the DSCR, debt service coverage ratio, is going to be equal to this divided by your debt service. So this covers the debt service at a ratio of 1.2x. So 1.2 times the debt service is what the cash flow covers it by. So there's about a 20% spread in there. Now usually you need to be 1.25x for this to be approved by a bank. But that's how you calculate your debt service coverage ratio. It's just the ratio that the NOI of the property, it's the ratio the cash flow of the property covers the debt. Okay, very simple. Now let's talk about cash on cash returns. Cash on cash returns now is, so I didn't have to buy this. Oh, this is why. This needs to be $3 million, not 300,000. All right, let's go back. All right, rewind. Assume I put 3 million down, guys. I was sticking this $1 million. Anyways, debt service coverage still doesn't change. Whatever terms I said is that. You know, let's make this simple. Let's go 450, because that's more realistic. 450. All right, we are covering debt service at a ratio of 1.33x. That's the ratio of these, okay? Cash on cash returns going into this property. Forget about increases and everything. Right now it's netting 600K. Debt cost is 450K. There's a spread now of 150,000 in there. Now, what is the returns of 150,000 in comparison to the actual money we put in the deal? We didn't buy that. We didn't actually spend $10 million to buy this property. We spent $3 million. So basically, this is just going to equal the difference between this minus this divided by your down payment to get a return. So we have a 5% cash on cash return based off this, because 150,000, aka the actual net cash on cash or net cash flow after debt service, is 5% return on your 3 million actually invested in it. So that's how you calculate cash on cash returns. The reason why people do this and people get debt, you're like, oh, 5%, that's less than the 6% cap rate. But the thing is, if you bought this for cash, and I'll show you this, you buy this for $10 million cash, and one day you increase this value, or the net cash flow, the NOI of the property, to 800K, that would just be an 8% cash on cash return. Okay, if you bought it in complete cash. So let me get rid of this. So if you buy it for $10 million and then you increase the NOI to 800K, that's only an 8% return on your money because you bought it all in cash. But you'll see here with the cash on cash return, since I only put $3 million into it, now I'm cash flowing 12% on my $3 million. And then over time you increase this to 900K. Now I'm cash flowing 15%. So you'll see you get a higher return on your money by leveraging bank debt. It might not be a higher return year one, but this is how you get the higher returns over time. And some of you guys might be asking, how do you know the rent's always going to go up? You look at a few different factors. So when you're buying a property, you want to buy in a desirable area that at least has a stable population or a growing population. Because a growing population, let's say you have an apartment building, you got 50, this is $10 million, $100,000 a door, 100 unit apartment building, right? Sorry guys, I'm having a brain fart. I got back from working out today. So if you have same population or a growing population, the growing population means there's an increased demand for housing. So you could reasonably assume that the demand for your housing is going to go up, which means you could raise the rents in comparison to the population growth if the inventory of housing obviously isn't growing. It's all supply and demand. We all learned this when we were in second grade. Now, also we have cash, the actual dollar value is inflating too. So if the dollar value, if inflation goes up 5% and then your population growth goes up 5% and everything else stays the same, the inventory out there, no one's developing new apartments. Let's say everything was exactly the same. You have 5% population growth and you have 5% inflation growth. You could reasonably raise your rents 10% that year because the demand is 10% stronger. Inflation, so the dollar's weaker, so you're going to adjust accordingly. And then also you have increased demand from the population, therefore you raise the rents to meet the increased demand. So that's why you could always reasonably assume, okay, cash is going to go up. And then your cash on cash returns is even higher. Let's talk about internal rate of return now. And this is the most important and what people actually quote when they're trying to raise money from investors and what this actually means. You don't want to look at cap rate, guys, because no one buys things on cash. It's just a quick way to say, what's this priced at? Oh, it's priced at a 7 cap. Oh, it's priced at a 6 cap. That's like easy, just numbers to throw around, because if you want to see if a deal makes sense, let's give me an example. If the cost of debt is right now 7%, and someone tells me, oh, this property is priced at a 5 cap, 5% cap rate, 5% return on the purchase price, how is that going to cover 8% debt? Doesn't always work out. So that's like just quick numbers to be like, oh, this probably doesn't make sense at a 5 cap. Why are you asking for a 5 cap when debt's 8%? Maybe there's a ton of upside with the deal and it's worth overpaying on the front end, putting a higher down payment to meet the debt service. That's a whole nother longer conversation. But typically cap rates is literally just a quick way. Oh, okay, what's the cap rate? Oh, is that overpriced, is that underpriced? It's like saying what's the multiplier on this business. It's not actually indicative of anything. It's really the debt service coverage ratio and the cash and cash returns are the main thing, but the internal rate of return is really what you're focused in on. So internal rate of return is your total rate of return on your money internalized over the life of the loan. So let's use this as an example. Year 1, year 2, year 3, year 4, year 5. Whatever I'm saying about all of the previous things now, we're just looking at returns on your money. So whether you bought this in cash and this is your percent returns, or you bought it with bank debt and this is your percent returns per year. There's typically going to be two things. There's going to be cash flow. There's going to be an exit. So let's go with exit. Cash flow per year. You know this is cash flow per year, so let's just, so each of these, I'm going to put a number down here. This is going to be your cash flow per year. Here's the percent profit you made on your initial investment on the exit, and then we're going to do total percent return. And then here we're going to have your IRR. So your IRR is going to be this total percent return divided by the amount of years you held the investment, the life of the investment. So let's do this. Make these all percentages just to make this nice and easy for you guys to read. Boom. So let's say you bought a property, cash flows 5% year 1, 10% year 2, 12%, 15%, 20%. Right? This is going to equal the sum of, do all this, nope, didn't mean to do that, do all that, and that, okay, and then you exited this for 38% profit on the actual exit of the property. So you got 38% more than you paid for it. You got to take that out of the property on top of the cash flow you were paid throughout all the years. That totals up to however much money was invested in the beginning. You made 100% return on your money after 5 years. What is the internal rate of return of that? We're going to divide this total return on your money, total percent return, you know what I didn't want to do to make this simple, total percent return on money invested. So this is the actual money you put into the deal. total percent return, divided by the total amount of years you held the loan or you held the investment. Okay, because that's year 5. I apologize. Let's just make this 5. Boom. It is a 20% internal rate of return because you made 100% on your money over the years. There's a lot of ways you can make 20% IRR. Maybe this was a crazy fixer-upper property and you did not you negative 20% because you had to put a bunch of money rehabbing things. And then you started filling it with tenants and you're at negative 10. And then eventually you broke even. And then next thing you know, you're at 15%. And then next thing you know, you're only at 20%. But then you sell the property for a crazy return on the back end because you fixed all the problems and now the property is better. So you negative cash flow, breaking even. You finally made a little bit of cash flow. You made a good cash flow, but then you sold the property at pretty much almost double the value. And now here you are with 100% return on your money after 5 years. That's another way to get to 25% IRR. Or you could literally make no money, spend no money, do nothing, no cash flow, nothing. You made 100% on the exit. Again, 20% IRR. It is your total percent return, no matter how the money shakes out, and then it's divided by the life of that investment, and that is your internal rate of return. How does this play into pricing, though? Here's an important thing. So there's few property styles, okay? There's the guys that want to do high risk in high growth areas, and that's going to be, let's say you're buying an apartment building here in Tampa, Florida. Tampa, Florida, because it's a growing area, properties are selling at almost no cash flow day one. But there's high rent growth, so your rents are going to go up drastically because increased population, increased everything. There's shortage supply and everything down here. So you're going to buy property without cash flow in year 1, but then it's going to cash flow a little bit in year 2, and then it's going to cash flow a lot in year 3, and it's going to cash flow even more in year 4, and it's going to cash flow a ton. And then maybe the property is double the value now. By the time you return, you get a crazy actual total return. So that's one way to do it. Other guys will buy properties in the Midwest and secondary markets, and they just have more stable cash flow, but no crazy bumps. So they might get 10% cash on cash returns year 1, 12%, 15%, 17%. 25%, and then they hit like maybe 31%, or let's go 21 just to make it simple, just make it round numbers. 21% classic return on the exit. So now they made all this cash flow throughout the years, they made this much profit on the exit, and then not 100%, so still 20% IRR. There's different styles, right? And you have to think, all right, what is this? And it's a risk game. Do I want to go the more risky process, but I'm in a higher rent growth market, or do I want to go to low risky process, but it's not as much high growth on the back end? The best investors are usually going to not highest risk, but largest market growth. But the thing is, you have less cash flow getting there. But any property in really good areas, like you're looking for equity appreciation, like that's really where the money's made. Yeah, you could buy cash flowing properties in secondary markets, but you're not going to have these crazy home runs you never expected in secondary markets because you're not going to have these crazy rent growths in secondary and tertiary markets versus in major markets like Tampa, Florida. I'm just using that as an example because I live here. So when you're valuing these properties, it's kind of like cap rate's irrelevant. You're really looking at cash on cash returns and internal rate of return. The problem with projecting internal rate of return is that you make these projections, and that's how you go raise money as a commercial real estate investor, or just project your own returns. It's hard to project what you're going to exit at because your exit is going to be dependent on cap rates, or not cap rates, interest rates. But a higher interest rate means you're probably going to sell at a higher cap rate, which means a lower purchase price. And they're irrelevant of each other, but typically the purchase price is a reflection of where interest rates are. So cap rates and purchase price are tied to each other. So when you might be assuming, hey, I'm going to exit this property at a 7.5% cap rate, but then you end up exiting it at a 9% cap rate. So now you made less profit on the actual exit than you thought. So let's say I broke even on the exit, and now I obviously didn't make as healthy of an IRR, even though my cash on cash returns and increased cash flow projections were correct. It's hard to predict your internal rate of return. So I know a lot of the best investors I see, and when we're in high growth times and rates are going down, like up until the 3% interest rates, some people are getting mid to high 2% if they were doing floating rate debt. When you're doing the, when you're looking at like great growing markets and the rates are going down and prices are going up, it's super easy to be like, oh, I'm going to exit this at such a great cap rate, such a high exit price. So like a lot of guys were ignoring cash and cash returns, being like, oh, we'll just make it up on the back end. Those are the people that are kind of in the water right now, if with these higher rates, because if their property is not going to appraise high enough to get out of it, they're pretty much in the red now for their investment. They might foreclose on it. Meanwhile, like the best investors I know, they look for cash and cash returns, but it's a balancing game, right? Because cash and cash returns is more predictable, because you can usually predict, if you have experience in operations and you do good at operations, where you're going to slowly increase the income of the property. Like in year one, I could make these changes to the property, I can make these improvements, clean up the books and records, clean up management, and increase the occupancy by this much. Year two, I can raise the rents by this much, increase the occupancy. You can usually predict where your cash and cash returns are going to go, because you have fixed rate debt. Now, if you do floating rate debt, you're playing an advanced game. But when you're valuing these properties, assuming you can cover debt service and the property can get financed, this is any commercial real estate, assuming we can get financed. Well, what purchase price do I want to pay for this? You're trying to aim for 20 to 25% returns, or IRR, because that's like doubling your money every 4 to 5 years. That's for mid-size, small-size commercial real estate. That's typical. Don't hold me to it, guys. I know like big funds, they might do 10% IRR for their investors. So, you know, it's a balance act. But you have to decide, well, do I value more cash flow on the front end, or do I value a stronger market with higher growth potential? But if there's higher growth potential, you need to figure out, well, how much cash flow do I need on the front end? And it's really a balancing act of how to get there. So guys try and buy at usually a spread between their internal rate of return that they underwrite to versus what they quote their investors. So I know guys that if they're quoting investors a 12 to 15% internal rate of return quoted, when they're raising money, they're usually shooting for like 20 to 25% actual internal rate of return on underwriting for the property. Because if they're wrong about the exit and they end up only bringing in like 18% internal rate of return, they're still getting their investor the quoted promise. And then if they end up doing way better than they thought, then that GP, or the actual buyer of the property who raised the money, they'll have some type of split where they split the profits on top of that really heavily to the GP, because it's like, hey, I got you more than your returns in your property, so I get to reap more of the benefits there. So that's kind of the balancing act of commercial real estate. You can see here on this underwriting, like we had to hit these terms to cover this. So $5 million purchase price. This guy needed $5 million. He needs $2.1 million to cover his original debt. This is the seller. So I was arguing to the buyer, listen, all right, even though you're doing a high down payment, 42% down, we're going to give you 5% interest rate, 7 years interest only. So it's lower payment. So you're going to cash flow good each year. And now we projected this. This is not a high growth area. So we only have, just for the advanced guys, you have 6% rent growth in the area. We're assuming you fill the occupancy by 6 each year. This is what that looks like, cash on cash returns. Year one's 9%, year two 13%, then 16%, 18%, 21%. Those are the years throughout. And then you could see here, he bought the property for $5 million. He sells it for assuming he could sell at a 7.5 cap in year 7, he'll sell it at around 9.38, 9.4 million. Minus like the loan payoff, closing costs and everything, he's going to net 6.2 million. So when he's getting this 1.3 million profit on top of the purchase price on the exit, combined with that cash flow over the years, he's hitting an internal rate of return of 25.44% in year 7. So I hope that kind of breaks down, or you guys could see what I'm saying here a little more exact. Like you can see the cap rate going into it's really low. Cash and cash returns, we had to do interest only because it helped us get higher cash and cash returns year 1 for him. We're actually doing 6 months deferred payment on this, so he's making way higher cash and cash returns, so we can offer his investors a higher preferred return. This is for the more advanced guys. But yeah, that's how the overall commercial real estate financial metrics, once you have everything settled, you know what the property is making, You know the terms, you're going to go buy it from the bank. You got to be looking at, can you cover the debt service? Can you hit the cash and cash returns you want? Can you hit your projected internal rate of return? Like, that's really what the skill of commercial real estate is. Knowing each asset class is really just knowing how to detect bullshit when someone is fluffing the income and expenses on you. But assuming the income expenses were all true, it's really simple. You just take the net income and you just figure out a purchase price that hits those main metrics for you. Does it cover debt service? Is the cash and cash returns good enough for me going into it? Or could I increase the property at reasonable rate, increase the income of the property at a reasonable rate that I could project out and get cash and cash returns along the way? And then, okay, once I'm in year 5, year 7, year 3, whatever year you plan to hold it to, reasonably, what do I think the property is going to be worth then on the back end? And then that's how you just look at your internal rate of return. Is this worth doing this investment or not? So I hope this video was helpful for you guys. If you guys enjoyed this, don't forget like and subscribe. If you don't know who I am, Armand Violi. I've done over $100 million worth of commercial real estate transactions. And then I have a free commercial real estate deal sourcing guide, completely free 36-page PDF showing you my exact processes for how I research property owners, how I find their cell phones, how I cold call them, how do I structure my database, how do I market to them with a combination of text and email blasts and quarterly calls, generate leads, negotiate off-market deals. It's for investors, brokers, agents, wholesalers, anyone looking to get in commercial real estate. This is the best guide anywhere on the internet, and it's free too. I should be charging money for this. Best guide anywhere on the internet for free that teaches you how to source off-market commercial real estate deals. It applies to almost any asset class out there. Link is in the description below, or go to CREDealAccelerator.com. You can download it there. Appreciate you guys watching.